Crypto is a scam. You've probably heard that phrase countless times. Maybe you've heard it from the media, from traditional investors, or even from people who believe cryptocurrency is nothing more than internet money designed to steal from ordinary people. And to be fair, there have been scams in crypto. There have been fake projects, fraudsters, rug pulls, and people who have lost money chasing unrealistic promises. But here's the question. Does that mean cryptocurrency itself is a scam? Because if we use that same logic, then we would have to say the entire financial system is a scam because banks have committed fraud, companies have collapsed, and investors have lost billions in traditional markets. The reality is much more complicated. Today, we're going to separate crypto from the scams built around it and look at why millions of people, institutions, and even governments are paying attention to this technology. Before we defend crypto, we need to understand why people are skeptical. And honestly, some criticism is justified. The crypto space has attracted bad actors because whenever there is a new technology with the potential for massive growth, people try to exploit it. We have seen fake investment schemes promising guaranteed returns, influencers promoting projects they secretly benefit from, exchanges that mismanage customer funds, tokens created purely to make quick money. These things happen, but the important distinction is this. A scam uses technology. It does not mean the technology itself is a scam. The internet was used for scams, email is used for scams, phone calls are used for scams, but nobody says the internet itself is a scam. The same principle applies to cryptocurrency. So, what exactly is cryptocurrency? At its core, cryptocurrency is built around one major idea: digital ownership without needing a central authority. Traditional money depends on banks and governments to process transactions and maintain records. Crypto introduced blockchain technology, a transparent digital ledger that records transactions across a distributed network. Instead of one organization controlling the database, thousands of computers around the world verify and secure the information. This creates possibilities such as sending money globally without traditional banking barriers, owning digital assets directly, creating financial services without traditional intermediaries, increasing transparency through public transaction records. Whether you believe crypto will replace traditional finance or simply become part of the financial system, the technology itself is a genuine innovation. One reason people are becoming more interested in alternative financial systems is because of something called debanking. Debanking is when individuals, businesses, or organizations lose access to banking services. Now, banks have legitimate reasons for closing accounts, such as fraud prevention and regulatory requirements. But the bigger question is, what happens when access to financial services becomes something that can be taken away? Money is not just numbers on a screen. It represents your ability to participate in society, your ability to pay bills, run a business, save, trade. And when people become completely dependent on one central financial system, questions about financial freedom naturally arise. This is one area where decentralized technologies like crypto are being explored, giving individuals more control over their own assets. Yes, crypto has risks. Anyone who tells you otherwise is not being honest. Crypto markets can be extremely volatile. Some projects will fail, some tokens have no real purpose, and many people lose money because they invest without understanding what they're buying. But risk does not automatically mean scam. Investing in stocks carries risk, starting a business carries risk, buying property carries risk. The key difference is education. The question should not be, is all crypto a scam? The better question is, which projects have real utility, real adoption, and solve real problems? Whether you love crypto or hate it, one thing is becoming increasingly difficult to ignore. The financial world is changing. Blockchain technology is no longer being discussed only by crypto enthusiasts. Some of the world's largest financial institutions, technology companies, and even governments are actively researching, testing, or integrating blockchain into their operations. Let's take a look at a few examples. BlackRock, the world's largest asset manager with trillions of dollars under management, now offers Bitcoin investment products and has also tokenized money market funds using blockchain technology. Fidelity Investments has been involved in digital assets for years through Fidelity Digital Assets, offering Bitcoin custody and trading services to institutional investors. JPMorgan Chase, once one of crypto's biggest critics, developed its own blockchain technology called Kinex, formerly known as Onyx, to facilitate tokenized assets and faster cross-border settlements. Goldman Sachs have launched digital asset initiatives, explored tokenization, and continues expanding its blockchain-related services for institutional clients. Franklin Templeton, one of the world's largest investment firms, has launched blockchain-based money market funds and continues exploring tokenized financial products. Payment giants have also embraced the technology. Visa has experimented with settling transactions using stablecoins and continues developing blockchain payment infrastructure. MasterCard has invested heavily in blockchain research and is building tools that allow financial institutions to interact with digital assets more securely. Even PayPal introduced its own US dollar-backed stablecoin, PYUSD, allowing eligible users to transfer value using blockchain technology. Another major player that often flies under the radar is the Depository Trust and Clearing Corporation, DTCC. Most people have never heard of the DTCC, yet it is one of the most important pieces of the global financial system. It provides clearing, settlement, and custody services for securities, processing transactions worth quadrillions of dollars every year across global financial markets. The significance of the DTCC exploring blockchain cannot be understated. DTCC has collaborated on supporting initiatives such as a May 2026 partnership with Chainlink for advancing 24/7 collateral management using blockchain technology. On May 27, 2026, DTCC and the Stellar Development Foundation announced plans to connect DTCC's tokenization service to the Stellar public blockchain. This is part of DTCC's multi-chain strategy that will enable tokenized versions of DTC custody assets, such as stocks, ETFs, and US Treasuries, to be available and used on the Stellar network. At the same time, institutions like the World Economic Forum have published extensive research on blockchain's potential applications in finance, trade, supply chains, and digital identity. And it's not just private companies. Governments and central banks across the globe are researching central bank digital currencies, also known as CBDCs. Countries such as China, Japan, and South Korea have already conducted large-scale pilots, while the European Central Bank, the Bank of England, and many others continue exploring how digital versions of national currencies could function alongside existing financial systems. Japan's Prime Minister just delivered a video address at the WebEx 2026, strongly reaffirming government support for Web3 and startups. Japan is one of the top 5 economic powerhouses of the world and is combining pragmatic regulation, tax incentives, funding, and events to build a mature Web3 hub. Another point that crypto critics often overlook is if cryptocurrency was nothing more than a scam, why would the European Union spend years creating one of the world's most comprehensive regulatory frameworks specifically for crypto assets? Rather than banning cryptocurrency, the European Union chose a different approach. It introduced a harmonized legal framework across all EU member states to regulate crypto businesses, protect consumers, increase transparency, and provide legal certainty for companies operating in the industry. Think about what that means. Governments don't usually create detailed regulations for industries they believe have no legitimate future. Instead, they regulate industries that are growing, attracting investment, and becoming important to the economy. We've seen this with banking, we've seen it with insurance, stock markets, and now we're seeing it with digital assets. MiCA doesn't say crypto is risk-free. It doesn't guarantee you'll make money. It doesn't eliminate volatility or bad investment decisions. What it does say is, if companies want to operate in the European crypto market, they must meet standards for governance, transparency, customer protection, and financial integrity. In other words, the European Union isn't treating crypto as some passing internet fad. It's treating it as an emerging asset class that requires proper oversight. That's a very different message from the claim that crypto is a scam. If anything, MiCA signals that digital assets are becoming part of the regulated financial system rather than remaining on its fringes. And it's not just Europe. The United States has also been moving toward clearer rules for digital assets through proposed legislation such as the Digital Asset Market Clarity Act, often referred to as the Clarity Act. When lawmakers spend years debating how to regulate an industry rather than how to eliminate it, it suggests they're preparing for its continued presence in the financial system. So when someone says crypto is just a scam, it's worth asking another question. If that's true, why are governments, regulators, banks, asset managers, payment networks, and financial market infrastructure providers all investing time, money, and resources into understanding and regulating it? If you found this video valuable, please subscribe for more content exploring the future of money, financial freedom, and building wealth God's way. See you in the next video.